Welcome back to another deep dive. And, I really want to welcome you, the listener, today, because if you're like me, you're the kind of person who just loves finding those little aha moments hidden inside really complex topics.
Right, without getting totally bogged down by all the heavy jargon.
Exactly.
Right.
We just want to get to the good stuff. And, well, usually when we talk about something like a medical diagnosis, there's this expectation of clinical precision. Like you break your arm, the x-ray shows that jagged white line, and the doctor just points and says, there it is, broken.
Yeah, the outcome is just entirely objective. I mean, the bone is fractured or it isn't. The math of the human body in that exact moment is undeniable.
Right. But today, we're taking that exact same expectation of, like, cold, hard precision and applying it to something that most people treat with just an overwhelming amount of emotion and anxiety. And guesswork, honestly. We're talking about wealth.
And we have a really incredible stack of materials today to get through.
We do. We have an expert-level institutional report here, prepared by a pseudonymous author known as Sir Margin.
From Kumo Solutions, but yeah.
Right. It's titled The Mathematical Architecture of Terminal Wealth. And the whole mission today is to decode this premise that wealth accumulation is not a function of speculative luck. It's actually a disciplined application of a mathematical law.
Yes. The sources basically treat financial growth as this exponential engine governed by a single central formula.
And there's also a supplementary document, right?
Yeah, freegame.pdf, which is fascinating.
It's so bizarre. It features a giant image of a Mijoux #1 carton. The fermented maize drink. I drink that stuff, and I have absolutely no idea what it has to do with institutional finance.
We will definitely get to that puzzle. But first, we need to set the stage with the machine, the actual wealth law we're talking about.
Right, the formula.
Right. It's the standard formula for compound interest. FEN equals PV multiplied by 1 plus R raised to the power of N.
Okay, let's unpack this, because reading an equation off a page feels like being back in high school math class.
It really does, yeah.
And the best way to visualize this machine, to really see the mechanics of it, is to think of wealth like a cross-country road trip.
Oh, I like that.
Yeah, so your PV, your present value, the starting capital that is your car's engine block, it's the physical metal moving you forward. Your rate of return is the quality of your fuel. Are you putting in high-octane racing fuel or like watered-down gas?
Right.
And the time you are actually invested, well, that represents how many miles of open road you have ahead of you. The future value is the terminal wealth, the final destination.
That physical analogy is perfect because what Sir Margin points out is that the vast majority of people completely obsess over the fuel.
Oh, totally. Everyone wants to go fast.
Right. They are constantly hunting for the highest rate of return, the hottest tech stock, the crypto coin that's going to moon. They just want the rocket fuel.
But having rocket fuel is completely useless if your engine block is tiny. Or, if you crash the car 10 miles down the road.
Exactly. The source material argues that the engine block and the road are mathematically far more critical. I mean, these variables represent actual human behaviors.
Break that down for me. What behaviors?
So PV, that starting capital, is driven purely by your savings discipline. Can you forego buying something today to build the engine? The rate of return is driven by asset selection and tax efficiency.
And time, the end variable.
That's simply a measure of how early you got the engine running.
So a protected engine running for 40 years on average fuel will always beat a Ferrari that runs out of road.
Every single time.
Which brings us to a massive vulnerability. You literally can't go on a road trip if your engine block cracks before you leave the driveway. And the sources have this counterintuitive take on protecting that PV lever.
Right, the engine base. It's the most vulnerable part of the equation. And protecting it revolves entirely around insurance.
See, I have to push back here on behalf of everyone listening, because people absolutely hate paying for insurance.
It feels like a grudge purchase.
Yes. It feels like you are literally throwing money into a furnace every month. Like, you see R1500 leave your account, nothing bad happens, and you think, man, I could be investing that in the stock market.
Sir Margin actually calls that specific psychological trap the illusion of gain.
The illusion of gain?
Yeah, it's the hallmark of an unsophisticated analyst, somebody who only looks at nominal numbers. Let's use the specific example from the text.
Okay.
Say you decide to skip that R1500 monthly premium. You put it in a savings account instead. After 10 years, you check your balance and you think, wow, I'm nominally up R180,000. I beat the system.
Honestly, yeah, R180,000 in my pocket today feels like a huge win. win compared to protecting against a tiny chance of a health crisis.
Sure, it feels like a win until the statistics catch up with you, say a critical illness strikes. Suddenly, you are facing medical bills or a loss of income costing somewhere between R400,000 and R2 million.
Oof. Yeah, that wipes you out.
Exactly. So if we apply net present value, or NPV, the decision to skip that premium carries a deeply negative mathematical value.
Wait, let's define net present value for a second, just so we don't get lost in the jargon.
Of course. NPV is simply a way of measuring what future money is actually worth to you today, but factoring in all the risks attached to it.
So the retail investor just sees the R180,000 and calls it a gain.
Right. But the institutional architect looks at that R180,000, weighs it against the probability of a R2 million catastrophic wipeout, and realizes it's not a gain at all. It's an unhedged liability.
Because if that catastrophe hits, your PV drops to zero.
And the entire formula collapses. ZO multiplied by any rate of return over any amount of time is still zero. Insurance is not a cost line. It's a risk-adjusted asset.
Wow. You pay the premium to guarantee the multiplier in your equation survives. That totally shifts the perspective.
It's just math.
Okay, so the engine block is shielded. Now we move to what the sources call the most potent lever of all, the road itself, time.
What's fascinating here is that n, the time variable, doesn't just multiply. It sits in the exponent of the formula.
Right, it's a power.
Exactly, making it mathematically the most sensitive lever, and it's the only variable that money cannot buy back.
I really want to walk through the cost of delay case study from the sources, because when you see the actual numbers, this exponent is terrifying.
Let's do it.
So we have two hypothetical investors. Both contribute the exact same amount, $5,000 a month. Both get the exact same return, 10% annually.
So the size of the engine and the quality of the fuel are identical?
Identical. The only difference is the length of the road. Investor A starts at age 25. They give the machine 35 years to run. Investor B waits until age 35, giving the machine 25 years.
And the results?
At age 60, Investor B ends up with roughly R6.5 million, which is great. But Investor A, who just started 10 years earlier, they end up with approximately R17.4 million.
That is a R10.9 million gap.
Wait, really? R10.9 million gap for just a 10-year head start.
Yes. And think about it. Investor A only contributed R600,000 more in actual out-of-pocket cash during those extra 10 years.
That's insane.
This is the time value of money in reverse. Usually we say $1 today is worth more than $1 tomorrow. But here we see the absolute penalty for delaying that first dollar.
Because it's just pure compounding. Interest, earning more interest.
Precisely. It has nothing to do with market luck or income. The math just relentlessly compounds what you give it.
Okay, so we've protected the engine, we've extended the road by starting early. Now we have to talk about the fuel, optimizing the speed of the machine, the
rate of return.
Yes, and here's where it gets really interesting. Because I'm looking at this freegame.pdf document. Why on earth is Kumo Solutions linking terminal wealth math to fast-moving consumer goods, like a carton of Mijoux #1?
It is a brilliant analogy. Sir Margin uses it to explain a concept called margin management.
Okay, I'm listening.
So look at companies like Premier Group, the ones who make Mijoux, or Iwisa Supersun. The data shows they achieve massive 57% EBITDA growth and maintain consistent 13 to 14% profit margins.
Let's pause on EBITDA real quick. Earnings before interest, taxes, depreciation, and amortization. What does that actually mean for the business?
Think of it as the raw, unfiltered cash the business generates from its core operations, before the government takes taxes or banks take interest.
So it just proves the underlying engine is highly profitable.
Exactly. But how do they keep that up during economic lockdowns or recessions?
That's what I want to know.
By focusing on operational efficiency and selling essential goods. They don't sell luxury cars that people stop buying. They sell dietary staples. And they cut out leaks. For instance, Premier utilizes 50 to 60% of its own wheat production internally.
Oh, so they are their own supplier.
Right. They eliminate the middleman. They eliminate operational leaks.
Okay, I see the connection to personal wealth now. You don't engineer a high R by gambling on meme stocks. You do it by operating like a consumer goods conglomerate. You plug your own leaks.
And what are the biggest leaks in personal finance?
Taxes and investment fees.
Bingo.
And the sources point specifically to tax-free savings accounts, or TFSAs, in South Africa as the tool for this. They cite the 2026 limits are $46,000 annually, up to a lifetime limit of $500,000.
Right, because inside that account, every dividend, every capital gain, all the interest is completely shielded from tax.
So your effective R is higher without taking on more market risk.
Exactly. You are structurally more efficient.
The text also brings up endowments and life policies, but it calls them synthetic bonds, which threw me a bit.
Yeah, that's a deeply institutional way to look at life insurance. These products are designed with embedded put protection.
Meaning a guaranteed floor, so your capital is safe from huge crashes.
Right. But the real magic, the reason the architect uses them is for their liquidity mechanism. They allow for policy loans.
How does that keep the machine running? Give me a real-world example.
Okay, imagine you own a R2 million house outright, and you suddenly need R100,000 for a medical emergency. You don't sell your kitchen to raise the cash.
Right. No, you take a loan against the house.
Exactly. The house remains intact and keeps appreciating. Policy loans work the same way. You borrow cash against the value of your policy.
Because if you sell your actual investments for an emergency, you're liquidating your base capital.
Yeah.
You're destroying your PV.
Yes. And you kill your compounding momentum. The loan lets the engine keep running while you handle the emergency.
Wow. Okay, so we have all these levers. We understand PV, the N exponent, engineering R. But a pile of car parts won't get you across the country.
No, you have to build the car.
Right. How do we assemble this into a blueprint that survives the real world? Which brings us to Kumho Solutions' 5-layer structural hierarchy.
And the order of these layers is everything. Layer 1 is the foundation. Insurance. We talked about this. It protects PV from a catastrophic zero.
Layer 2 is the buffer. 3 to 6 months of liquid emergency savings. And the mechanism here is crucial. It eliminates forced selling.
The causality is vital. If the market drops 20% and your car blows up the same wet, Layer 2 pays the mechanic. You aren't forced to sell your stocks at the bottom.
So Layer 2 physically protects the layers above it.
Exactly. Then you have Layer 3, accumulation. This is your TFSAs, your retirement annuities, optimizing R via tax efficiency.
Then Layer 4 is the growth engine. JSE equities, SADC regional exposure, the real mathematical heavy lifting.
Right. And finally, Layer 5, asymmetry. Options, alternative investments, big upside bets.
If we connect this to the bigger picture.
Actually, the institutional report issues a massive warning here. If we connect this to the bigger picture, most retail investors try to skip straight to Layer 5.
Oh, they totally do. Everyone wants the high alpha asymmetry without building the foundation.
And the source references Matthew 7.2427. It's building a house on sand. Without layers 1, 2, and 3 as shock absorbers, one economic storm wipes out the entire structure.
We can see that storm risk in the Layer 4 data. They analyzed the 2025 to 2026 Sanlam High Equity TFSA. It delivered a 16.42% return, 3.21% standard deviation, and a 2.63 Sharpe ratio.
Let's translate those last two. Standard deviation is basically turbulence. A 3.21% standard deviation means the journey is exceptionally smooth.
And the Sharpe ratio, 2.63 sounds high.
It measures if the turbulence is worth it. Risk-adjusted return. Anything over 2 is phenomenal. If your Layer 4 is too volatile, people panic, sell in a dip, and permanently destroy their unlever.
But even with a smooth ride locally, we have macroeconomic risks. Like in March 2026, the Rand was the worst performing major currency globally, and the JSE dropped 10.45% in 1 month.
Which is why institutional architects use a global hedge. They use feeder funds at Layers 3 and 4.
Like Dodging Cox or Seraphim, which the report mentions. So mechanically, I put my Rands into a local fund, but it feeds into global portfolios priced in dollars or pounds.
Exactly. When the Rand weakened in March 2026, those global holdings acted as a counterbalance. The Rand value of those offshore assets actually increased.
So it mechanically insulates your wealth from a single regional economy.
Yes.
So what does this all mean? If we step back, the insurance foundation, the liquid buffer, margin management, the global hedge, and that relentless exponent of time.
It means wealth is just a predictable machine. The math of FEN equals PV times 1 plus R to the power of N does not care if you're investing R500 a month or R500 million.
It doesn't care about excuses. It just compounds what you give it.
And that is incredibly empowering.
Yeah.
But it demands responsibility. And, I want to leave the listener with a final thought that extends beyond just money.
Okay.
We established that N time is the most powerful exponent in the universe. But that exact same mathematical architecture applies to human capital, too.
How so?
Think about the accumulation of your knowledge, or your career skills, or your relationships. Those are compounding assets.
Oh, wow.
So what invisible compounding engine in your life are you unknowingly running at a deeply negative net present value right now, simply because you are delaying the start date?
Man, if wealth or knowledge, or relationships, are a road trip. You really don't want to wake up one day and realize you've been sitting in the driveway with the engine off for a decade.
Exactly.
Protect your base, optimize your fuel, and give yourself the longest road possible. Let the math do the heavy lifting. Thanks for joining us on this deep dive.